While I was doing some research for a completely different topic, I came across this post on Reddit, which said, "Am I the only one who believes long-term investing sucks?" And there are two main points to this Reddit post. The first two can actually be summarized into a single one, which implies that it's very hard to control yourself when investing for the long term. You have to control yourself for 30 years or more. And so, how do you plan to manage your selling temptation when the market is in drawdown? How do you ensure that you will never ever sell your holdings in a few years after you start investing if the market stays in the red for a few years? Or even worse, how can we as long-term investors deal with market crashes like what we experienced in 1929? And the claim here is that between 1929 and 1932, the S&P 500 dropped by 84%, and then it finally returned back to 0% in 1954, after 25 years of the crash. So the question is, how can you manage this risk that the same thing can happen when we are investing? And the second point to this Reddit post is that you have to exit the market at some point. So when do you get out of the market? How do you determine the right time to start withdrawing your money? Now, I thought these are some interesting arguments and they're completely valid. So I wanted to address them in this video because I'm sure there are many people out there who may have the same concerns about long-term investing. In fact, it made me realize that there are a lot of things that we aren't told when we open a Stocks and Shares ISA and start our long-term investing journey, which can cost us a lot of money. And it's got nothing to do with specific skills or investment strategies. Okay, so the first point of the Reddit post was that it's very hard to control your emotions for such a long period of time in the market. And that's actually a very valid point, because the harsh reality about long-term investing is that staying invested for extended periods of time, no matter how the market is doing, is indeed much harder than it seems. However, there are simple things that we can do as investors to help us remain invested no matter what. The main reason why controlling yourself for such a long period of time is indeed very challenging is because unfortunately our psychology works against us. One of the less talked about areas of finance and investing is behavioral finance. This is, in my opinion, the most fascinating area of finance because it exposes critical mistakes that we all make when it comes to managing our money and investments. Let me give you an example. Which of these options would you prefer? Option A, 100% chance of gaining £900, or option B, a 90% chance of gaining £1,000 and you get nothing the other 10% of the time? Most people will probably decide not to take the risk and instead go for the sure bet of £900. But if you think about it, the expected value of these two options is exactly the same. With option A, you get £900 100% of the time, so our expected value is £900. But with option B, you get £1,000 90% of the time, and then the other 10% of the time you get nothing. So again, our expected value is £900. But because one of these options is more unpredictable than the other, it does make slightly more sense to go with a sure bet. But now let me ask you a second question. Which of these options would you rather? Option A, a 100% chance of losing £1,800, or option B, a 90% chance of losing £2,000. Now you've probably noticed that I've just doubled the numbers from the first question, and instead of posing this as a gain, I've just framed it as a loss. But other than that, this is exactly the same question. You can either take the risk or you can take the sure bet. Again, option A and option B have the exact same payout ratios. But when this question is framed as a loss, you're reacting totally the opposite way. What I'm trying to illustrate with these examples is that this is a flaw that we all have as humans, called the loss aversion bias. It's a strange phenomenon whereby the pain of losing something is psychologically twice as powerful as the pleasure we get from gaining it. In other words, we hate losing so much more than we enjoy winning that it leads us to making totally irrational decisions. Which brings us nicely onto our next flaw in our psychology, confirmation bias, which is a tendency we have to search for information that either supports or confirm our existing beliefs. For example, if you think the stock market is overvalued and about to crash and you're sitting in cash on the sidelines, you're going to seek out information that confirms that view. So when you go on YouTube, you're likely to type in things like reasons why the stock market is about to crash, because you actively want to find information that is going to support your view and make you feel better about your position. But what's worse is that once the YouTube algorithm works out that you're searching for this this type of content is going to feed you more of the same. But couple this with the negativity bias, which is another flaw we have, and it gets even worse. The negativity bias says that we tend to give negative events more attention than the positive events. And the finance and investing industry knows about these flaws very well, which is why you see article after article filled with negative headlines. So once you combine the confirmation bias with negativity bias and the loss aversion bias, you end up seeking out negative headlines and content that confirms your views and make irrational investment decisions. Now, fortunately, most of these cognitive biases can be overcome by putting processes in place that ensure you're looking at both sides of the argument. So how do we deal with this then? How do we ensure that we will remain invested for the long run no matter what happens in the market? Well, it all starts with having an understanding of how the stock market and long-term investing actually works. Nobody likes looking at red investment accounts, especially if you just started recently. But here are the facts. If we look at the S&P 500 as an example, if you're a long-term investor and continue to stay invested in the market no matter how it performed, the worst 20 years delivered a return of 6.4% a year. And the best 20 years delivered an average return of 18% per year. In other words, there has been no period of time in the S&P 500 over a 15-year period or more where you would have lost money even when you started investing in the worst possible environment. All you had to do was stay invested. Also, this chart shows that despite facing decade after decade of wars, recessions, and financial crises, markets continue to climb higher over the past 30 years, with the S&P 500 returning a total annual return of 9.83%. Now, to address the second point of this Reddit post, how can we as long-term investors deal with market crashes like we experienced in 1929? The fact is that during market crashes like the one in 1929, is actually the best time to be invested, because that's when everything is on sale. This is the best thing to happen to a new investor, since markets will rebound and then go up again, and that's when you make your money. Now sure, the S&P 500 index didn't return to its previous high for 25 years after 1929, but that in no way translates to actual investor experience. This data doesn't account for accumulation of dividends, and it assumes that people just invested a lump sum at the market peak and then nothing afterwards. But that's not how we invest. Instead, we steadily contribute month after month, which would have greatly accelerated the recovery of capital. And the fact is that for most people, it took only 4.5 years to see their portfolio bounce back and break even. Just because the market didn't see a new all-time high for decades doesn't mean you're underwater for decades. If you're buying the entire time, you're in the green way before the market makes new highs. This is why you shouldn't stop buying in any market, and you will lose if you do. In terms of when you exit the market, well, the simple answer is that you never exit the market. In reality, what we will do is change our asset allocation from 100% stocks and add some bonds and cash perhaps. As you age toward retirement, you have less need for growth and more need for stable assets to preserve your capital. So you'll have more money in cash and, depending on interest rates, some in bonds. But the bulk of your money, 50% I would say, will always stay invested in the stock market. You will never withdraw the entire investment pot that you've accumulated over the years. Now, it's worth mentioning that even if you prepare yourself in advance and have a complete understanding about how the stock market works, for most people it's still not going to be an easy ride. And the simple reason is that many people just haven't experienced a market crash before. Sure, keeping a long-term investment mindset and holding onto your investments is easier said when the market is going up. But when things are going badly, the story is completely different, especially when you have a large investment pot, because you have more money to lose. And when I say lose, I mean paper losses, because you won't actually realize the loss if you don't sell your investment. And the reality is that many people who started investing have done so after the financial crisis of 2007-2008, meaning that they have only ever experienced the market rising. And I wouldn't say that 2020 was much of a crash, because it recovers so quickly. However, next time the market crashes, just remember that decades worth of market data show that staying invested through volatile times has been a smart route to take to pursue long-term financial goals. So if you're investing for goals that are 15 to 30 years away, you just need to let the money compound over time, because remember, time is on your side. Now, it may seem boring to just do nothing, but the reality is that long-term investing is supposed to be boring, which is the second thing that no one tells you about. There is a massive misconception among new investors that investing is like a scene from The Wolf of Wall Street. Lots of yelling on the trading floor while trying to make a profit. They assume that investing means daily trading and believe that to be a good investor, you need to constantly buy and sell things. returns. But trying to make money like this is not investing. It's more like gambling. And by doing that, you have more to lose than gain. Remember that when you gamble, the house always wins. The problem nowadays is that apps like Freetrade and Trading212 here in the UK make it very exciting to invest. They hook you by offering you a free share when you download their app and use these cool flashy interfaces that are meant to encourage people to trade. The issue here is that you might make a lot of money in the short term, but over the long term you're almost guaranteed to lose money. So these apps are actively driving risky behavior. Don't get me wrong, it's an exciting way to invest since you're making moves all the time, and it's a whole lot more mentally stimulating than auto investing 10% of your income in an index fund every month. But if you want investing to be exciting, then you're doing it wrong. In reality, successful long-term investing should be boring. And how do you make investing boring? You pick a broadly diversified index fund, set up your investments to happen automatically month after month, and that's it. Ignore financial headlines, ignore the daily market volatility, and just keep making those investments month after month. Just a note of warning though, that's not to say that you should hold on to a bad stock for the long run and you'll get great returns. That's far from it. This is about sticking to your quality assets through thick and thin. Now, I can see why it may be difficult to simply do nothing, but the third point on my list is that you don't need to know about 99% of the information about investing in the stock market. The problem with investing nowadays is that we're exposed to way too much information about the stock market. What's the market outlook for the next year? What are the best stocks at the moment? Is the market going to crash, and so on? All of this information impacts our expectations about investment returns and influences our decision-making process. It's quite ironic because you'd expect that by staying up to date and learning about everything that happens in the investment world will make you a better investor. But more often than not, that's just not the case. The truth is that you don't need to know 99% of the information and news about the stock market. In fact, you don't even need to know that much about investing to be able to build long-term wealth. All you have to know is that the stock market moves up and down for all kinds of reasons, and you shouldn't react every time that happens. That's it. As long as you have a low-cost, diversified portfolio, there isn't really much else you need to care about. So the idea here is to reduce the number of decisions that you have to make, because that's just another opportunity for your emotions and biases to get in the way and mess things up. Which leads me to my last point. Keeping things simple works best. The fact that nowadays there are so many index funds, ETFs, and stocks ready to invest in, you're made to believe that if you don't invest in a certain fund or stock, you're missing out on a lot of gains. However, the truth is that you don't have to buy the latest fund or the hottest stocks this week. As long as you're investing in broad market, low-cost index funds like the S&P 500 or even the entire world, you don't need to spend a second of your time wondering whether you should buy certain companies because you own all of them. Of course, the investing industry knows about our biases very well and has to promote the latest stocks and portfolio strategies. After all, they make their money by making you feel as if you're missing out. But the truth is that you only need one or two quality index funds in your portfolio to build wealth in the long term. Now, here is my last point, which is actually the real problem when it comes to long-term investing. Many people have unrealistic expectations about investment returns. Schroders published a study in 2023 which measured the views of 23,000 investors from all over the world. And when asked about what their expected returns for the long term are, on average, investors said that they expect a return of almost 11.5% per year. And just for comparison's sake, the MSCI World Index of Global Stocks has delivered an annual return of 8.16% per year in the past 40 years. So it appears that after more than a decade of outsized returns, many people have been conditioned to expect high returns from the stock market. Now, there is nothing wrong with being optimistic about the future, but if we expect things to deliver a much greater than average return year after year, we are setting ourselves up for failure. And the problem here is that many people are planning their future financial lives and retirement based on certain misbeliefs about how markets will perform, and as a result are putting too little into their investment pots. On top of that, while returns of 10 to 12% per year sound good, people forget about inflation. For example, if you were to invest £300 or dollars in the S&P 500 every single month since 1993, it would now be worth over £760,000. But if you adjust that figure for inflation, the real value of the portfolio is actually £357,000. The fact is that money loses its value over time with inflation, and that affects our investments too. Therefore, if your investments average a a return of 6% per year in the next 20 years, but inflation will average 3%, the real return in your investments is actually 3%. It's obviously still much better than keeping your money in a savings account. But regardless, inflation is something that people often forget about when thinking about investment returns. Also, make sure to open the right investment account, such as a Stocks and Shares ISA here in the UK, to avoid paying taxes on your investments. But before you do that, check out this video next to learn about 6 key things that no one tells you about the Stocks and Shares ISAs. Otherwise, you risk paying a lot of money in taxes.